My view about the Chinese economy is we are going to hear more monetary policy easing, perhaps a little bit of a fiscal expansion as well. But the core issue in the Chinese economy has not really been addressed. That is, the private sector does not have the investment interest. And the government's fiscal spending is coming to the stage that they could not push very aggressively. So there won't be another 4 trillion stimulus similar to what we saw in 2009. For the stock market, I think the government's going to try hard to stabilize the market. But the problem is policy credibility has been lost over the past 6 weeks, so that whether the market would listen to what the government said for a sustained period of time, for the time being, we don't know. So that's the picture that we foresee where the Chinese economy is heading to. Some headline positive news from policy front, but the real economy probably will remain quite sluggish. My view about Asia Pacific is that while we might see some demands from the rest of the world, but if the Chinese demands comes down, the rest of the world's exports will continue to face downward pressure. And the domestic demand almost across the board is relatively weak, so that we think the growth prospect remains a little awkward. In that background, then we do believe that the central banks do have room, almost all the countries, to make further monetary easing. It might be in a different formats. They may take different kind of measures, but overall, I think it's going to be easing biased in the monetary policy.
We expect Asian currencies to continue depreciating through the end of the year, although we do see some differentiation in the currencies across how they're priced against the forwards. There are really 3 main factors that we think will continue to drive the currencies: EM growth, US dollar strength, and the Chinese yuan. Starting with the first of those, weakness in emerging markets growth has really been the main reason emerging market currencies in general, and the Asian currencies in particular, have fallen this year. We expect Asian growth to begin to stabilize, maybe even improve a little bit over the next several months, but weak exports and still very high debt overhangs in most of these countries means that we don't think that growth recovery is going to be strong enough to drive a powerful capital inflow response. The second factor that we see driving Asian currencies weaker is US dollar strength. History makes very, very clear that when the dollar rallies against the major currencies, it rallies against all EM currencies. The Chinese yuan is the third factor we see affecting Asian currencies. We forecast the yuan to weaken to 650 to 660 to the dollar by the end of the year. Our modeling work suggests that if the yuan weakens, that should add to pressure for Asian currencies to soften against the dollar. We're bearish, so the main risks to our view are bullish developments. One is that Asian growth could begin to surprise to the upside. A lot of capital has left the region's markets. A lot of bad news is in prices. If growth begins to surprise to the upside, some of that capital could come back into the region, helping to support the currencies. The second main risk to our forecast is that the dollar doesn't rally against the major currencies. If the dollar doesn't rally, then that will take some of the pressure off of the Asian currencies. But I think ultimately what's going to determine the trend in Asian FX is going to be whether Asian growth improves or remains weak as it did in the first half of the year.